Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I want to introduce you again to Dan Foch, who is the podcaster, host of the Canadian Real Estate Investor Podcasts, a guy that follows the real estate business very closely, as well as other economic issues. And Daniel, you've been posting quite a lot lately about the condo crisis in the Greater Toronto Area. Tell me about what you think is going on.
Yeah, it's something we've been watching for a while now. It appears to have really just gained traction with the more mainstream outlets, especially with the CIBC report recently. So CIBC and Urban Nation, which is, I guess, the biggest research firm around pre-construction sales in the city of Toronto, put out a report that basically shows how the majority of condos are cash flow negative. And one of the pieces that I think that hasn't really been explored is that they're also equity negative. So they would most of these people who are taking possession would actually have no equity in the property. So if they sold, they would be losing most, if not all of the cash they have into the deal. And this has kind of become a headwind for the pre-construction condo market because over the next year or so, we have a record number of completions. So 2024, we have record completions. A lot of them have been pushed back due to delays in COVID or problems like the ones that we're kind of talking about now. And so buyers of these condos who purchased them kind of at the height of the market in 2020, 2021, when rates were exceptionally low and prices were exceptionally high, um, those buyers are kind of disincentivized to want to take possession of these units. And it's created, from my perspective, a pretty big problem, pretty big potential risk for Canada's economy moving forward.
You said condos are the biggest challenge facing Canada's economy right now.
Yeah,
Condos are going to
I
challenge
think
the whole
so.
economy?
I think so, honestly. I think that if you examine like the oil and gas industry as an example by employment, it's like 1/10 the size of the employment of the construction sector. The unrealized losses in the condo market would be in the tens of millions of dollars. That would, I mean, there's really only three ways that it could play out, right? So number one is you let it burn to the ground, and that would obviously be the biggest um, potential issue is if we, let all of these owners go bankrupt, let all of the builders go bankrupt, and then we have to try and figure out how to solve that problem over the next several years and pick up where we left off. So let's just assume that we're going to exclude that one from the range of potential outcomes because I can't see any policymakers really deliberately going down that path. Um, Number two would be you end up in the situation where we're in right now, where banks are doing as much as they possibly can to accommodate this. In some cases, violating the rules that they're supposed to follow in regards to loan to value because they're financing based on a loan to purchase price. Um, and banks are kind of being forced to, let's call it, bail this out. It's a private sector bailout, basically, because the banking system in Canada is exceptionally strong. Um, and that'll allow these projects to finish and liquidate, and it'll allow the construction industry to continue working because that's, from my perspective, the biggest risk, the knock-on effect is you have, I think, 1.2 million people employed in construction across Canada, almost half of them in Ontario. And, the absolute majority of construction activity is in the Greater Golden Horseshoe, which is where all of these condos that I'm describing exist. So if you see a big, well, let's just think about it with the data that we have. Um, Pre-construction sales are down like 50 to 60%, depending on which month of the year that you're looking at. In January, it was down like 70%. So if 2 years ago we were selling 70,000 units a year, and this year we're going to sell 10,000, that means in 3 years or 2 years, when typically the projects that are sold today would start construction, you have a 50 or 60% reduction in construction activity in 2 years. And if that all coincides with the time at which all of these existing projects are going to be completed, which it does, simply because we have record condo completions for the next 2 years, then you have a big gap in the construction labor pool, and that has knock-on effects. And that's just the the labor side of things. And then you also have all of these owners who are taking possession that they're described in the CIBC report, where they're all cash flow negative, many of whom, I think 30% of them are cash flow negative $1,000 a month. And so that's $1,000 a month that's going to interest to banks, which is why the banks have an incentive to help out in this situation. That's not going to consumption or spending or growing businesses or whatever it is. And so there's this massive drain on the economy that will last for 5 to 10 years based on what we know about the scenario. And to me, that is by and large the biggest problem facing Canada's economy today.
This problem that you're identifying really isn't 2 years out, is it? I understood that there's 80 projects that have already put on hold this year in the Greater Toronto Area.
Yeah. I mean, I think last Ben Towell had estimated it. He said 2/3 of condo projects were shelved earlier this year, or sorry, I guess late last year. And then we also have, like, if you just look at Tarion enrollment statistics, there's hundreds of projects that are contemplated, approved, and want to launch, right? They want to go sell these units, but they would be selling these units into a market that has no liquidity, that isn't prepared to buy those units. And we basically have a standstill in the market, a stalemate, where, like you're saying, a lot of existing projects are being shelved, or a lot of projects that would be launched aren't being launched. And again, so this is a huge contraction in an industry that was one of the biggest contributors to our GDP in the last 5 years.
But it seems like it's just in the condo market right now. Do you think it's going to stay there? Logically, if you've got this huge amount of condo inventory out there, where effectively what you're saying is that you can rent it cheaper than you can own it, and so therefore there's going to be a lot of rental accommodation available at reasonably attractive prices. And record deliveries both last year and this year and next year of these condos. So one would think that there's a whole bunch of people that are looking for places to live. They're going to be moving into these condos and renting them. Don't you think that should have an impact on the townhouse market, the single family home market, or why is it completely separate?
Yeah, it's a great question. There's a couple of reasons. So the first reason is the speed at which each of the products are built. The second reason is, and so that's kind of why it wouldn't have an impact, or it already has had an impact. And then the second that would kind of agree with what you're alluding to is that there would be like a wealth effect, right? So let's just look at the first one. Condos take 4 years to build, and when you're building them, you have to wait for the entire building to be complete, so you can give all of the units to the purchasers, and then you liquidate your construction loan. So you take the money that you sold all those condos, and you pay out the money that you borrowed to the bank to build those condos. With ground-based or detached houses, townhouses, you're selling 5 houses at a time. And so you only have to build 5 houses, and then you can pay out that portion of the construction loan. So it's self-liquidating. If it's an individual house, every time you close a house and deliver that to the purchaser of that home, you pay off that portion of your construction loan. And so the ground-based was much more agile. It's probably the best way to call it. So when prices came down in 2022, when we saw the biggest price drop in Canadian history, they had already priced that in within months. And we saw a year ago people protesting Mattamy for forcing people to honor the contracts that not forcing them, asking them, because that's a deal's a deal, right? But people were protesting Mattamy because they were selling houses kind of without giving the buyers profit. And so again, detached houses just responded a lot quicker because it's a much more agile supply chain for one unit. Condos, because they're, the projects that pre-sold in 2020 are just being completed now. You have 4 or 5 years of market activity that took place in the meantime that people are vulnerable to, and that's what we're seeing materialize now. Whereas that vulnerability had already been realized in ground-based almost instantly. To answer the question about, like, should it trickle into those markets, I would say yes. The two biggest ways is, like, condos are typically the first rung on your property ladder. And so if people are losing money on condos, then they have less money to go spend on the next product. But the other piece, and this is one I think that there's really no way to possibly know how how big this problem is. Um, but is that a lot of people who were buying pre-construction condos were taking the money off of a HELOC, home equity line of credit, and using it to make a real estate investment. And the format they did was a pre-construction condo. And so that negative wealth creation or the loss of that is actually going to impact their household balance sheet. And it could actually make them more likely, if they can't sell the condo because the condo market has a record number of listings right now, then they might actually be inclined to sell the detached house that they have the home equity line of credit on, liquidate, maybe go rent for a little bit, and then try their hand again or try and rebuild that wealth in some other way.
Let's try to put this in perspective. I was told that there's something like 28 months of condo inventory, and the typical would be 6 to 8. Is that sort of the statistic that you're aware of?
It sounds a little bit higher than what I would see, but yeah, I mean, we have at least triple or if not four times the typical amount of condo inventory that we have right now. I mean, I guess because summer months are so slow, and with how much inventory is sitting there right now, if you were to use one of the last months of sales to measure condo inventory, then yeah, you could end up with several years worth of inventory if you maintained a July sales pace, right? I think there's more condo listings than we've ever seen on the market, and there's fewer condo sales than we've ever seen on the market. And that says a lot, because that data set starts in the 90s when our population was 10 to 15% smaller, right? So it's a pretty profound position for us to be in.
Pretty profound position for us to be in. We're going to take a break for some messages and be back in just 2 minutes with Daniel Foch of the Canadian Real Estate Investor Podcast, talking about what's going on with real estate, particularly in the condo sector. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about pre-construction condos, the real estate market, and what's going on with Daniel Foch, who is the founder of the podcaster, host of the Canadian Real Estate Investor Podcast. He's a gentleman that follows the real estate sector incredibly closely, posts very frequently, and I follow him so I know what's going on because he knows what's going on. Daniel, let's take a step back if we could, just for a minute, and you could tell us sort of what these impacts are on these condos. Because I'm getting, and I'm sure lots of people are getting, emails on a regular basis and messages on social media on a regular basis of assignment sales, of distress sales, of condo listings, et cetera. So you were saying that there's losses potentially for condo buyers, people that bought pre-construction condos a couple of years ago. Explain to us, the money that ends up being transacted, how much money they put up front in deposits, how much money they've got to deliver on the end, and what's happening.
Sure. So when somebody commits to purchasing a pre-construction condo, typically they'll put, I mean, deposit structures vary, but probably the most typical one would be you'd put 5% down on signing. So you would give 5% to the builder to hold that unit for you when you first sign the agreement. After that, you would typically be given a period of a couple of months to come up with the next 5%, and then a couple of months after that for another 5%, and then a couple of months after that for another 5%. So total, maybe one year would be like on the short end, 2 years would be kind of on the long end. You were seeing some even further extended deposit structures, like 3+ years, but you have basically a year to 2 years to come up with 20% of the purchase price of that unit. And just the easy way to think about kind of one of the challenges that this created was, it was kind of undisputable that a resale condo at any given point in time in the last 30 years was a better deal than a pre-construction condo. Builders were actually building in the potential increase in value after 2019, actually probably after 2016, 2017, when the market for condos really started to rip. So you could go buy a resale condo for $950 a square foot, and across the street you could buy a pre-construction condo, and it would cost you $1,200 or $1,300 a square foot. Maybe that's a bit of an extreme example, but that example probably does exist. Um, and you get the pre-construction condo would be brand new, so that would be kind of the advantage. But also the advantage that I think a lot of people saw was you didn't have to put 20% down right away. You could spread it out, and so it actually selected for people who couldn't really afford the full 20% down to buy an actual resale investment property on that day. And this has kind of created a little bit of a challenge where people were drawing on a HELOC or, using their income to come up with a down payment rather than actually having that cash set aside for investing. Um, on closing, typically these individuals are expected to come up with whatever development charge, any differences in development charges, as well as some closing fees. It can vary. I've heard as low as like $30,000 to $50,000 extra, and those are closing costs, et cetera. HST in some cases. I've heard as high as like $120,000 in extra closing fees that you end up paying when you go to take possession of the unit. It would really vary based on the builder, based on what's changed between when you committed to purchasing the property and when you actually take possession of the property. But there's a
And the
lot.
and the
Yeah,
eighty
sorry, go ahead.
percent and the 80% of the purchase price you haven't paid yet.
Yeah, so sorry, I guess that piece. So typically when you go to purchase, you are asked to provide a letter of credit or some sort of mortgage commitment from a lender. And the challenge is, a lot of these commitments were given in a 2% rate environment, and now we're in a 5% rate environment. So a lot of people are saying, oh, this condo is a great investment at 2% interest rates, not thinking, oh, well, I have to take possession of it in 4 years or 3 years in a completely different rate environment. But yeah, so you would have to come up with an 80% mortgage. Typically, most people weren't paying that cash, and that's where things kind of get really ugly, right? Because those mortgages are now, three on your average condo. I guess a $600,000 condo, $480,000 mortgage. That mortgage is now $2,700 a month, whereas you probably underwrote that deal assuming that mortgage was going to be $1,900 a month.
And maybe some people have firm commitments when they made those first deposits back 4 years ago. But a lot of people, don't they have to apply, not reapply necessarily, but get a new appraisal. The debt service coverage ratio that they once met when interest rates were 2%. They have to see if they can meet at the current numbers, and they're not getting those mortgage monies anymore.
Yeah, no, you're absolutely correct. Your GDS and TDS ratios would be massively skewed by the increase in mortgage payment. And so if you qualified at 2%, it doesn't mean that you qualified at 5. Especially now, with the stress test, like you have to qualify at 7%, right?
So what happens if the bank that you thought was going to lend you the money doesn't lend you the money?
Then you would go to a B lender, I guess, or you would go to a different bank. You would shop the debt product around, which is what a lot of people do. Now, based on the CIBC report that we were looking at to begin the show, they mentioned 75% of these deals are being done by big five banks, and so it sounds like the challenge is that if you as soon as you go to a B lender, all of the problems that we just described about TDS and GDS ratios get worse because you're paying a higher interest rate. And so, if you go to a B, and actually CIBC outlines this in the report, they show how bad the cash flow negative is on a typical A lender condo, and then how bad the cash flow negative position is on a B lender condo. And because the rate is so much more on a B or Alt A loan, the investor's further compromised by having to go to that last resort lender, right? But that's really the only way out. Or you sell the condo immediately and take the loss, which I think a lot of people are starting to realize is maybe the better option.
And so I'm getting lots of emails about assignment sales, and I was told there's like over 1,000 websites advertising assignment sales. So explain, if you could, what's an assignment sale?
Yeah. So when a lot of these purchasers took the contracts that I mentioned before, those contracts often had, and probably the most popular contracts had an option for them to sell that contract or sell that unit to somebody else. And there was a big period of time where um, social media, especially TikTok, I find, and a lot of like the newer real estate professionals were marketing this as a strategy to make money in real estate in Canada. That you could um, basically buy a pre-construction condo and wholesale purchase it and then flip the contract to somebody else closer to the closing date at a value and make make it maybe $100,000 because the unit had gone up that much in that period of time. And that worked actually for 2, 3 years. And so I think people heard about it and they heard, oh, this is a really easy way to make a lot of money with very little money into it, very little risk. And it created this extended problem where not only do a lot of people not have the means to close these units, a lot of people didn't want to. Like they had no intention. So you have more and more buyers piling into the market where they're buying it to assign the contract. And to assign the contract means that I'm gonna, in 2020, I commit to buying a unit at $1,000 a square foot, and at some point between 2020 and when the unit's completed in maybe 2024 or 2025, I expect to sell that at $1,200 a square foot. And I would just sell the contract to somebody else. They would give me the difference, and then they would be on the hook to close. And builders like this because technically, if the person who purchases the assignment fails to close, then the original purchaser is still on the hook. So it's evolving into a very big mess.
And the numbers are pretty astronomical. Giving your example of buying at $1,000 a square foot and selling at $1,200 a square foot, the deposit that you put down was 20%, $200,000, and the profit that you made was similar 20%, so $200,000. So you made 100% on your money.
Yeah.
Because you were investing in something that was worth $1 million or $1 million, going to up to $1.2 million if it was 1,000 square foot condo, but you're only putting down 20%. So it was like buying an option where you could make big money. The problem is it also can go the other way. And so if the condo goes from 1,000 to $800 or $900 a square foot, you can lose $100,000 or $200,000. You can lose 50% or 100% of your money. And I'm told that there's a lot of people that are walking away from their deposits, that they're losing their full deposits today.
Yeah, so you're starting to see and this is where we've sort of estimated these unrealized losses that we're talking about. The assignment market is you're basically at the point where on certain projects, buyers are willing to walk away from their deposits entirely. In some cases, buyers are even willing to pay people to take the contracts on because they know, I mean, if you play the tape to the end and really examine what a worst case scenario would look like if you're a purchaser of one of these units, if you fail to close, you immediately forfeit, let's say your 20% deposit. And then if the builder has to go and resell that unit at market value, and the market value is, let's say, 30% below, then they can still sue you for the damages that you created by not honoring that contract. So the other 10% that you owe them, let's say they get 20% from the deposit, but they've still realized a loss of 10% on that unit. They can sue you for that 10%. And they can win based on court precedents in the province of Ontario. And so some people are saying, okay, well, I'll discount this 25% because I know that I'm saving at least 5% because if this is a builder who has a history of being litigious, or I know that this is a builder who has already expressed an intention to collect those damages, because people are having these dialogues with the builders now proactively, which is smart. I would always encourage people to do that if you're in a position where you can't close. But this is kind of the mess that's evolved where people are basically undercutting the market because they're trying to offload the units, right? And it's functionally devaluing projects before they've even closed. Because if you're selling an assignment in a building that is worth $1,200 a foot and you're selling that assignment at $1,000 a foot and the market pays that price, then that's the market's price on that building right now. That's the part that's becoming a mess.
I don't know if you've got the statistics, but again, I'm told that a lot of these problems exist with investors that don't just have one condo, but actually went and, did this three, four, five, six times.
Yeah, you're absolutely correct. I think there was a period of time where people felt the investment was so compelling that they said, "Why would I just do one of them? Why don't I do two or five or 10 of them?" And that's that's where, I mean, there were controls. Like I think when builders and sales offices started to realize that this was happening, they started to try and control it. So they would say, okay, they would only let people buy one unit, or they would check with the lenders if this person had gotten a pre-approval letter for any other buildings. But then the people would just go to five different lenders, right? So you would say, oh, I'm going to go buy five pre-constructions, and I'm going to go get an approval letter from, bank one for unit one and bank two for unit two from builder two. And so that was kind of the circumvention where people figured out how to do this without getting caught or getting tripped up by the prevention mechanisms. And in those cases, like where people were really going that far to circumvent rules that are there, designed to protect them and the system from what is currently taking place, um, it's really hard to sympathize for people in that position.
Daniel, how did we get into this situation?
I think interest rates going down for 30 years probably would be the first piece of the problem. I think the next piece would be probably creating the scenario in which our construction market finances pre-construction. I mean, it was one of the best in the world, but because the U.S., like as an example, they use typically like mud bonds, municipal bonds, and then also they have a much stronger capital markets than us, right? They have 2,000 financial institutions where we have a couple hundred, and so they can raise capital and build a building on spec and then sell the units. Like when I talk to a lot of US bankers about this problem in Canada. A lot of them are watching it very closely, and they'll say, well, why would somebody buy a unit that they can't take possession of it for 5 years? And that, like, that in the US, it's like, if I'm going to buy something, I want to move into it right away. So I think that that whole philosophy where you're buying a unit in a different market than when you're actually going to take possession of the unit created the ability for 5 years worth of market risk to materialize. And that whole thing was basically done because the way, I think you and I have talked about this before on the show, but I'll give people a recap, is the way that builders finance projects here is pre-construction investors, or like the people buying those units, are functionally investors in the project. So if I'm a builder and I want to take possession, or sorry, I want to launch a condo project, I'll buy land for, I don't know, I'm trying to make the math easy here. Buy land for 10 million bucks. I'll zone the land, and maybe it's worth 15 or 20 million now. And I'll take, so the equity that I just created in that, I spend maybe, I don't know, $1 million doing the whole approval process, getting my entitlements. And I just created a bunch of equity. So I have now at 50% loan to value, or yeah, typically would put a loan on it to take my equity back out, and then I would use some of that money to build out my sales program. So I would spend some money on marketing, build out a sales office, do my unit layouts, get some massings done, all of the marketing stuff. And then so I have a little bit of equity from my land lift, $10 million, and I need, I don't know, 500 million to build the project, right? And so I would typically go and pre-sell these units, and the buyers give me that deposit. And once I've pre-sold 70% of my units, a bank will typically say, "Oh, I have enough confidence in the project that that you have buyers for this project that I'm willing to give you a construction loan for that project." But what you have to do is you have to insure the deposits in case the project fails. Those deposits get insured by Tarion, and there's a couple of other private insurers that kind of play in that space. But Tarion's sort of the process. Once those are insured, you can actually kind of, I don't want to say use them as project equity, but if you look at like, I think the biggest insurer in that space would be Westmount Guarantee. On their website, it says, we have $5 billion worth of, or I can pull up the number for you, but it's in the billions of dollars, X billion dollars worth of purchaser deposits working for builders, right? So that kind of becomes part of their capital stack or part of their equity. And then um, a bank, a big six bank, typically will finance that project, finance the construction of that project, and that kind of is how we created the problem, because builders rely on pre-sales to, and this is kind of how it's been since basically the last correction in the 90s. Builders rely on pre-sales for this to, or for their projects to become viable, and they rely on investor buy-in. And now all of these investors are basically being killed by the market, and so there's no more investor buy, and the product is too scary. So there's no more investor buy-in, which means there's no more units, which means that we have a big problem in 3 years, 2 years. I mean, we have a big problem today, but it's going to be far worse in 2 years.
I think it's going to be far worse in the next 6 to 9 months. I
Yeah.
think that some of this problem might be solved in 2 years with reduction of interest rates. I don't think interest rates going back down to where they were, but going down a little bit could improve that cash flow negative analysis that you started off the show talking about. But they're not going down that quickly in the next 6 months, and so I think there's going to be a lot of investors that have got $100,000, $200,000, $300,000 worth of losses on every one of a couple different pre-construction condos that they bought, and they're going to have trouble. Number one, closing, and number two, if they close, meeting that cash flow requirement they talked about. I do think that there's going to be a bunch of condos that were intended to be sold. They're going to be put on the rental market. And so I think it's going to be good potentially for renters, ironically. But I think there's going to be a whole bunch of small investors that lose money. And I think that one of the challenges here is that the banking sector is almost going to not encourage, but create a situation where the small investors lose money because they don't want to be in a situation where they don't lend the money, which means that the investors default, which means that the condos aren't sold, and then the construction company, the developers, got to sue the purchasers, and in the meantime, the construction loan either isn't paid off and or comes due, and the developer defaults, and then you've got a vicious circle of investors defaulting, developers defaulting, and if the developers default and the banks don't get paid back, then the banks get losses. And so it's one of those sort of ironic things that the whole banking sector has an incentive almost to make sure that these small-time investors actually take uneconomically expensive financing, because if they don't, then their banks are going to have to take the negative impact.
Yeah, 100%. I think you're already seeing it take place. Like the banks, I mean, the more logical place for the risk to exist for the banks is on, 100 purchasers, right? 100 individual purchasers rather than one builder. So if I'm a big five bank and I own a construction loan on, or I have a construction loan on, one of these towers that's under construction, it's $1 billion, and I know that this project can if it closes, then that loan will get paid out. I have an incentive to make sure that all of those purchasers get loans as well, and because now you kind of, I'm always reluctant to use the word, but you kind of socialize the risk, right? Like you take that risk and you spread it out over society. You spread it out over 100 or 1,000 purchasers, in this case 50,000 closings that we have over the next little bit, and take it off of the back of a bunch of builders. And so functionally, like, I've sort of publicly mentioned that I feel that the industry will need to be bailed out. I think that it is already being bailed out by the big five banks because they're strong enough. Like they're probably financially stronger than the government, and they're bailing out the sector right now and shifting that risk onto these investors or speculators. And it is absolutely within their right to do that. And I think it's fine to do that. And I think that the economic Darwinism that you're talking about taking place, where a lot of these investors are going to have to go bankrupt or insolvent or whatever, is probably a necessary part of the healing process for Canada's economy. One of the small challenges with it that I think is beginning to be observed by people in the industry is that if you're a bank and you're lending at 80% loan to purchase price on a condo that, again, we go back to that $1,200 a square foot unit, and now that condo is worth $1,000 a square foot unit, 80% loan to purchase price is much higher than 80% loan to value. And it's kind of a gray area of some of the banking rules in Canada. And I think that's going to become a headwind probably for financial institutions in the next couple of years.
I think it most certainly should be. And I think that frankly, that risk should be taken by the banks because they lent, money that wasn't economically justified. And the reality that all of the losses should be socialized as you describe it and taken by all these small investors, I think is wrong. But I think that's what's going to happen. We're going to take a break for some messages. We'll be back with Dan in just 2 minutes talking about what's going on in the real estate sector, particularly the condo market today. Stay with us, everyone. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Daniel Foch. He is the host of the Canadian Real Estate Investor Podcast, and we're talking about the condo market and the real estate market. Dan, how can people access your podcast? Where can they go find it?
Typically on Apple Podcast. We're all on all platforms: Apple Podcasts, YouTube, Spotify, etc. Or just the Canadian Investor Podcast.com. We have 2 shows on the network. So the Canadian Investor Podcast is just regular investing, and then the Canadian Real Estate Investor Podcast.
Excellent. I really appreciate it. I follow you on LinkedIn, and I find your posting really quite interesting. You made a post just recently about Canada's GDP.
Yeah.
And I think you suggested that on a per capita basis, we're actually in recession. And the only thing that's keeping us out of an actual recession is the growth in the population. Tell me about that, if you could.
Sure. I mean, it's interesting because people have a hard time understanding how, both what Finance Minister Chrystia Freeland said about how the IMF says Canada will have the highest growth GDP next year in the G7, and Canada's GDP per capita will be the worst in the G7, can both be true. And so the reality is, to boil it down very simply, if your population is growing faster than your GDP, then your GDP per capita is falling, right? So GDP per capita is a pretty widely used measure of standard of living, right? That's how much economy can be distributed to individuals. And so in Canada, we know, and the Fraser Institute kind of created this report to forecast, we expect GDP per capita to be the lowest growth in Canada over the next 30 years. And people are like, how can you forecast out 30 years? We have 100 plus years of economic data on the rate at which an advanced economy is capable of growing. And we have a pretty clear indication of what every political leader in Canada intends to grow our population at. And it seems like the rate at which most political leaders intend to grow our population exceeds the rate at which our economy is capable of growing, which would mean that our economy will grow, and it will definitely grow because we will be adding people to the population. That's more people consuming, that's more people working, etc. But because there's more people being added to the economy, the number of times that you have to slice that pie increases, which means that each person gets less pie or less economy, less money from the economy. I hope that's a clear enough explanation of it.
Yeah. And now on the statistics that you posted from the Fraser Institute, you show that our per capita GDP is going to grow at 0.78, so less than 1%, but still positive. But some people think it's actually negative today.
Well, GDP per capita has actually been falling for 7 consecutive quarters. So, and it's kind of tough, like, GDP hasn't been growing much because we are kind of in a more recessionary environment. Post-COVID, there was, I think, a lot of reconfiguration of the economy, but also our population has been growing at 3 to 4%. I think last year's, the most recent annualized growth rate based on permanent residents plus non-permanent residents is like 4.5% or something, just shy of 4.5%. We're like one of the top, I think we're the top 3 fastest growing places on earth right now from countries. And it's very tough for GDP to grow at 4.5%. So if GDP is growing at a normal rate of 1 to 2%, then your GDP per capita is falling massively in that scenario. And that's what's happened basically since the, I guess, 2022. And if you look at our GDP per capita, it's basically in line with where it was in 2016. So we've seen almost 10 years of no economic growth on a per person basis.
10 years. of no economic growth on a per person basis. And
Yeah.
then you posted that Canada has a record number of skilled tradespeople, but not enough construction activity. And you're suggesting that the construction business is going to slow down. What's going to
Mhm.
happen to all those construction people and those construction workers?
It's a really good question. I mean, I think that that's sort of why I implied that I think that an easy way for the government to fix this problem is to help these projects that we're talking about earlier in the show liquidate so that the builders can get back to building, right? If they can take money out of their projects and move on to the next project, then the construction industry will keep trucking. If the government doesn't do that, and the way I've implied that would be the easiest way to do that is through a loan, right? So they could, I mean, there's CMHC financing for other types of housing, for first time home buyers, owner occupied dwellings, MLI Select. So they provide, I think we talked about this on the last show, but they provide high loan value and long extended amortizations for purpose built rental. If they applied a product like that to a lot of these inventory condo units, it would help builders liquidate and then move on to the next project. If they don't do that today, then we'll have to deal with this problem in 2 years, where you will have I think we're already seeing it based on that article that I shared. Um, and in that scenario, I would say that the only thing they can do is a massive infrastructure spending bill. And so it's really kind of a what's the worst, what's the best evil, right? Do taxpayers want to see the federal government insure away the risk on these loans through a CMHC program, which would be a far lesser burden and actually an income generating activity for the government. Um, and it would also help kind of like relieve the burden because taxpayers already bear a bunch of that burden. We insure all of these first time homebuyer loans as an example, which are all equity negative now if they bought in 2022, right? Because if they bought at 95% loan to value and the market went down 5%, they're underwater. Um, or in again, you have to put in billions and billions of dollars into infrastructure spending to take all of these trades who now are not going to have work because there's no high rise being built. And they're all people who work on concrete or steel or rebar or whatever, very qualified to do infrastructure projects to build bridges or public sector buildings or whatever. There will be spending required to put those individuals to work, or you have unemployment in the double digits. And I don't really see another way out of it, to be honest. I wish I did, but I don't.
So, given our current debt and deficit positions, does the government have the financial fiscal wherewithal to do this massive infrastructure spending that you're talking about, and or effectively guarantee all these loans?
I mean, I think the loan guarantee part is interesting, because they've already committed to purchasing 50% of Canada mortgage bonds. So and that's actually, again, that's a revenue generating activity. So basically, if you go back on the Bank of Canada website, the Bank of Canada stopped buying Canada mortgage bonds, but the government of Canada started, and they increased the issuance of Canada mortgage bonds from $40 billion to $60 billion. So there is a lot of capital available for basically the way that they insure mortgages is CMHC writes an insurance policy on these mortgages, and then those mortgages get purchased off of the banks and sold into Canada mortgage bonds. And 50% of those mortgage bonds are going to be purchased by the government. 50% of those mortgage bonds are going to be purchased by investors, pension funds, sovereign wealth funds, other people all over the world, et cetera. Um, and so the way Canada finances those purchases on their own is they can go and give out they can go borrow money at 4%, let's say, government of Canada bond yield. That's their interest rate. Oh, I have to pay 4% if I'm going to borrow money from the private markets. And then they go and lend that money to buy these Canada mortgage bonds, on which they go and spend that money to buy the Canada mortgage bonds at 4.5%. And so they make that 50 basis point spread. So they actually generate income from this activity. And that's why I think if you're going to do it, you do it as a debt vehicle rather than a infrastructure spending vehicle that is really just like you're saying they don't have the money to do it. That's money that they would have to come up with and issue more debt. And our government just quite simply can't do that right now. And I think that the 2025 election, whoever wins it is going to be forced into a period of austerity based on the setup that we're in right now. And that's most of the G7. Like we're actually not as bad off as many other places in the G7, but that's what the Western world is going to look like right now because of all the spending.
Let me raise one other issue with you, if I could. So you said that most pre-construction condos have 70 or maybe 75% sold before they get their construction debt, and then over time, the developer will try to to sell the rest. Some people think that there's 10%, 15% of those condos that are still not sold, and the developers want to wait until completion because in the past prices went up and they could wait until the completion, and that was the profit. And so therefore, if everything that we've talked about for the last 45 minutes is true, that profit is eroded, if not completely evaporated. And the developers don't have that opportunity to make money either. Is that true? And if that's true, what happens?
Yeah, so it is. It's I would say most builders held back inventory with the idea of selling it at a higher price later in the future. And now that higher price can't be realized. And so you have a bunch of builders who are sitting on what these are called inventory units. So these are units that are still new, could be sold, but the builders are kind of trapped in a tough position. And adding to that is any of these failed closings, any of the failed closings where people can't take possession of the unit, those go back into inventory and the builders possess those units as well, although they get the deposit. So they kind of, let's call it, own those units at a 20% discount. So the first problem is that the builders, when the banks originally gave the money to the builders, they assumed that the builders were going to sell at X price. And if that price isn't realized, then the project can't liquidate. And so builders can't really reduce their price substantially without compromising the loan and not being able to exit the project. They also can't reduce their price to sell that inventory because it would devalue every other owner in the building, and that would create reputational risk for them. It would piss a lot of people off. It would reduce values or equities in the building. And so it's not something you're really seeing. You are seeing it in limited cases, and that's actually where that Mad at Me protest evolved before on the ground-based stuff, the detached houses. But with condos, it's not really something that's common yet. There are some buildings where there's some inventory in the market and it's kind of priced comparably to the resale market, and so people would rather buy the brand new than the resale. I guess the biggest challenge from my lens on this thing is if this product is all just sitting there and it's all competing and the market is completely full of units and there's nobody lining up to buy them, the market's functionally no bid, then we should probably figure out something to do with those units, given that we have a housing crisis, other than just letting them sit empty, waiting for a buyer to come and purchase them, which is not going to happen. Really, it's just not, and there's more and more of these units being added every day. So there are some inventory lenders who are allowing these units to be rented out. So you can take it, but technically an inventory loan is basically a line where they're giving you money and you are going to pay it off as soon as you sell the unit, and you're actively trying to sell the unit. Now that exit is gone, we have to come up with a new product. And this is again where I was mentioning, I think CMHC would be very wise to step in and help to create this product, because it is ensuring and advancing their goals of creating housing, to create a rental product for builders to hold these units on their books at a much cheaper loan to value, or sorry, a much cheaper monthly burn rate than an inventory loan. Maybe they do get on those 30, 40, 50-year amortizations that's available to an MLI Select borrower, and the builders have to rent those units out. And now all of a sudden, it's an easy win as a policymaker if you're creating 10, 20, 30,000 rental units. Like we see the federal government right now going out and doing big pressers for 35, 50, 100 units, right? If they could create 10,000 units and in the process save the construction industry from a big downturn, to me that's a huge political win. I think it's a tough sell, and the way I mentioned it was kind of as a builder bailout, which obviously nobody's gonna be in favor of. But the reality is, I think that it's a necessary thing that it'll probably take place quietly. Nobody will really hear about it, but I think that everything I've described needs to take place will likely take place. It's kind of already happening. Just the private sector is doing it, not the government.
Yeah, I don't think it's a bailout at all. I think actually it's probably one of the best investment opportunities right now. Start with your premise that we have a housing crisis. And if there's 28 months of inventory based on the numbers that I knew of condos available, and that doesn't include the builder inventory condos that you were just talking about, why not go in and buy them all up, or finance someone to go in and buy them all up and convert them to rental, purpose-built rental effectively, and rent them out at scale, rather than have all these small-time investors that are renting out one or two or three condos. Have someone come in and buy, as you say, 10 or 20,000 condos that are there for the taking on what historically is the cheap, and not bail people out, but take advantage of the current pricing marketplace to get a whole bunch of new housing accommodation that people so desperately need.
For sure. Yeah, I completely agree. I think it's one of those things. It's a tough. Well, I think the government's pretty slow to process this data as well. Like I've spoken on the podcast. We did an interview with both the housing minister Sean Fraser and shadow housing minister Scott Aitchison, and I've spoken with them and their policy teams about this issue. I think that it's just hard because you have CMHC, who's a more bureaucratic institution running the data, and it's going to take them 6 months to discover what I just kind of presented to the public, right? And that's just the nature of how we collect data in Canada as well, right? I mean, even mortgage delinquency is a good example, right? Like mortgage delinquencies in Canada are rising, but those are 90-day-old delinquencies, and then you get that in a quarterly CMHC report. So the delinquency data that we're looking at is 4 to 6 months old in most cases.
Daniel Foch of the Canadian Real Estate Investment Podcast and the Canadian Investment Podcast. Thanks so much for joining us. Really appreciate it.
Yeah, my pleasure. Thank you.
You know what? I think this is going to be a tough market in the next couple months, if not, frankly, couple of years in the condo market, in the pre-construction condo market, and it's going to be really tough on a bunch of small-time private investors that committed a couple of years ago to those pre-construction condos. But I do think there's a potential opportunity, and that is if people are well capitalized and have some money to go in and buy some of those opportunities and turn what CIBC in the report Daniel was talking about is a cash flow negative scenario into a cash flow break even. And then because of the growth in population that Daniel was talking about, because of the housing crisis we're in, after this current dip, I do think pricing is going to go up. And so therefore, longer term, you can make a lot of money. But that's the old thing about, buy low, sell high is the right strategy, but it's risky because it's low and people don't like buying when things are out of favor and the market's not attractive. And so it's a risky contrarian strategy, but I think it's actually a smart one. Well, we'll see what happens. Daniel, we'll check in with you again. Thanks so much.
Thank you.
That's our show for tonight. Thank you for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. And all of my podcasts are also available on Apple, Audible, Speakeasy, SoundCloud, etc. Thanks for joining. Good night.